Global silver stockpiles just slipped into a zone every commodity analyst fears: functional zero. Not because the world suddenly stopped mining the metal, but because the buffer that stabilizes a modern supply chain has effectively disappeared. Exchange inventories, once measured in hundreds of millions of ounces, now sit at levels better described as operational residue. The metal still exists, but the surplus that kept prices orderly, manufacturers calm, and financial markets confident has evaporated. This shift didn't announce itself with a single headline. It emerged through months of steady withdrawals from COMEX and London vaults, months of refiners reporting longer lead times, months of industrial buyers quietly moving from just-in-time procurement to strategic stockpiling. Each data point looked manageable in isolation. Together, they form a picture with only one conclusion. The global silver market entered 2025 with no margin for error. The implications extend far beyond precious metal investors. Silver anchors the electrical infrastructure of the modern economy: solar panels, electric vehicles, medical devices, data center hardware. The absence of inventory means any disruption in mining, refining, or logistics transmits instantly into higher costs and production delays. Markets accustomed to paper liquidity are discovering the limits of physical scarcity. Behind the headlines about price volatility sits a more consequential reality. A commodity once treated as abundant is now defined by constraint. And when a market loses its cushion, it starts rewriting its price structure, its risk structure, and ultimately its role in the global economy. Silver has reached that point. Silver entered 2025 in a position no modern commodity market can tolerate for long: inventories drifting toward functional emptiness. The headline numbers tell the story with unusual clarity. Exchange-monitored stockpiles, once considered deep enough to absorb demand shocks, have thinned to levels that barely cover a few weeks of global consumption. The world hasn't run out of silver. It has run out of available silver. The clearest stress signal comes from COMEX. Registered metal, the category actually deliverable against futures contracts, has slipped into territory analysts previously considered hypothetical. A system designed to warehouse tens or hundreds of millions of ounces now operates with volumes that resemble a rounding error in a billion-ounce annual market. At the same time, London's vault network, long viewed as the backbone of global allocation flows, reports its lowest inventories since the data series began. The market isn't functioning with surplus, it's functioning on fumes. This tightening has produced a dynamic that rarely appears in stable commodity environments: persistent backwardation. Futures prices sit below spot, a sign that buyers increasingly value immediate access to physical metal over a contractual promise of future delivery. In precious metals, backwardation isn't a pricing curiosity, it's an alarm. It signals that the market's confidence in timely replenishment is fading, and that the balance between physical demand and available supply has shifted from tension to strain. Industrial buyers are responding accordingly. Solar manufacturers, electronics producers, and automotive suppliers have begun placing earlier orders and holding larger inventories, quietly shifting from just-in-time logistics to just-in-case buffers. Refiners report longer lead times. Fabricators note tighter availability of high-purity feedstock. Each adjustment reflects the same underlying reality: the system has lost its cushion, and any additional drawdown risks forcing real-world rationing. Financial markets are absorbing this pressure as well. Option volatility has risen, spreads have widened, and delivery notices appear with growing frequency. Price discovery, the mechanism that normally balances the interests of hedgers, speculators, and end users, is tilting toward those who require physical settlement. A market long dominated by derivatives is being pulled back toward the constraints of geology and supply chain capacity. The immediate question is no longer whether inventories are low. It is whether these levels are compatible with a global economy that depends on uninterrupted silver flow. That question sets the stage for a deeper look at why demand has surged far beyond what the system was built to handle. The pressure on silver inventories begins on the demand side, where consumption has shifted from cyclical to structural. The metal is no longer merely an industrial input. It has become a foundation of the global energy and electronics ecosystem, pulling volumes higher at a pace the supply chain was never designed to accommodate. The most powerful force is the solar industry. Photovoltaic manufacturing has expanded from a niche sector into one of the largest industrial consumers of silver worldwide. Each panel requires conductive paste that cannot be meaningfully substituted without sacrificing efficiency, and installations continue rising as governments lock in multi-year renewable energy mandates. The result is simple. Silver demand tied to solar is no longer optional. It is policy-driven and accelerating. Electric vehicles amplify the trend. As automakers shift from combustion engines to electrified platforms, the silver load per vehicle rises. Modern EV architectures require more sophisticated power electronics, sensors, and thermal systems, all dependent on silver's unrivaled conductivity. The industry may debate battery chemistries and drivetrain configurations, but every configuration requires the same metal that's already in short supply. Communications infrastructure adds a third layer of demand. The expansion of 5G and the early construction phases of 6G networks are increasing consumption at the component level. Base stations, high-frequency switches, and network hardware depend on silver-coated contacts and specialized alloys. The growth may appear incremental on a per-unit basis, but the scale of global rollout transforms small increases into meaningful aggregate demand. Then comes the quiet but relentless pull from data centers. As artificial intelligence reshapes computing requirements, hardware density increases. AI servers, cooling systems, and power management modules use more high-purity silver than traditional data infrastructure. These facilities operate continuously, and procurement teams are increasingly focused on securing stable metal flows rather than simply negotiating price. Medical and defense applications round out the picture. Antimicrobial coatings, imaging equipment, aerospace electronics, and guidance systems rely on silver because performance margins are non-negotiable in these sectors. Substitution is limited, and procurement persists regardless of economic cycles. These uses were once small enough to ignore. They no longer are. What ties these sectors together is not speculative enthusiasm, but engineered necessity. Silver's role is defined by physics, not sentiment. Its conductivity, reflectivity, and antimicrobial properties cannot be replicated at scale, and each new deployment of modern infrastructure embeds more metal into long-lived assets. Much of this material will not return to the market for decades, if at all. This expansion in demand would be manageable if supply were keeping pace. It isn't. And the constraints shaping that imbalance reveal why the global stockpile depletion is not a short-term anomaly, but a structural shift with long-term market consequences. The tightening of silver supply isn't the result of a single weak mining year or temporary disruptions. It stems from a structural limitation that has been forming for more than a decade. Production trends, geological realities, and capital allocation patterns all point to the same conclusion. The system cannot replenish what the world is now consuming. The constraint begins with geology. More than 70% of global silver production arrives as a byproduct of mining for copper, lead, and zinc. That dependency makes silver supply inherently inflexible. Miners respond to base metal economics, not silver prices. Even when silver rallies, production cannot rise unless base metal markets justify new capital investment. When copper or zinc prices stagnate, the associated silver units stagnate as well. The linkage suppresses supply responsiveness precisely when demand accelerates. Primary silver mines, the segment theoretically capable of responding to rising prices, face challenges of their own. Ore grades have declined steadily, forcing operators to move more earth for fewer ounces. The economics of new development have become more complex, shaped by permitting delays, environmental regulations, higher energy costs, and jurisdictional uncertainty. Bringing a new mine from discovery to commercial output can take 7 to 10 years under favorable conditions. Under current regulatory frameworks, it often takes longer. Markets move faster than geology. Recycling, often viewed as a relief valve, provides less support than theory suggests. Recovery rates from electronics remain low because the silver content per device is tiny and widely dispersed, making extraction economically inefficient. Solar panels lock silver into 25 to 30-year lifespans, keeping growing volumes outside the recyclable stream for decades. Industrial processes are optimized to reduce waste, not create reclaimable inventory. The result is predictable. Recycling contributes meaningful volume, but nowhere near enough to counterbalance structural deficit. A separate constraint emerges from geopolitics. Countries with significant mining capacity are increasingly prioritizing domestic demand. Export restrictions on strategic minerals have become more common as governments attempt to build internal manufacturing bases for batteries, solar components, and electronics. Even where silver itself is not restricted, the host metals, copper, zinc, lead, face policy environments that can limit downstream availability. The world is discovering that supply chains designed for globalization do not function seamlessly in an era of fragmentation. These constraints feed directly into the tightening seal and exchange inventories. COMEX and London vaults were never intended to be the world's emergency reservoir, yet they have been treated as such. As industrial users drew more heavily on physical supply and investors moved metal from registered to eligible or private storage, the visible buffer declined. The leverage embedded in the paper market, multiple claims on every ounce, magnified the illusion of abundance. But leverage cannot create metal. It only delays the recognition of scarcity. The outcome is a system unable to rebuild stocks at any meaningful pace. Even sustained high prices would take years to stimulate supply growth. And during those years, industrial demand continues to climb, absorbing every marginal ounce the sector can produce. That mismatch creates the conditions for the next stage, the economic and financial reactions that follow when inventories fall towards zero across the world's exchanges. The consequences of near-zero inventories do not appear all at once. They unfold through a series of linked reactions, each feeding the next, each tightening the system until price becomes the only remaining regulator. Silver is now entering that phase, where scarcity begins shaping behavior across industrial supply chains, financial markets, and sovereign balance sheets simultaneously. The first reaction emerges in the physical market. As fabricators and manufacturers confront longer lead times, they move from routine procurement toward defensive purchasing. Orders shift from quarterly to immediate, volumes rise, and tolerances shrink. Premiums increase as suppliers ration allocation based on relationships and reliability rather than price alone. This adjustment may look incremental, but it signals that operational planning has become subordinate to material availability. A just-in-time framework cannot function when the buffer disappears. The second reaction develops inside the futures market. Delivery requests increase, short positions roll less comfortably. The spread between paper liquidity and physical obligations narrows until brokers begin anticipating stress rather than responding to it. In this environment, risk departments play a larger role than traders. Margin requirements rise, position limits tighten. The quiet question that underpins the entire derivative structure, is there enough metal to deliver if asked, starts moving from theoretical to practical. Markets do not panic on rumors of scarcity. They panic when participants begin acting on it. The third reaction affects industrial cost structures. As procurement teams compete for limited supply, volatility seeps into long-term planning. A solar manufacturer facing uncertain feedstock availability must adjust capacity plans, contract terms, and pricing models. An automaker designing next-generation EV platforms must stress test silver inputs the same way they analyze battery metals. Businesses used to predictable commodity flows are now revisiting assumptions that held for decades. The adjustment is not merely financial, it is operational, influencing design choices, supply chain architecture, and investment timing. A fourth reaction emerges at the sovereign level. Countries exposed to geopolitical risk or currency volatility often view precious metals as strategic reserves. When inventories fall and physical markets tighten, the incentive to accumulate increases, not decreases. This dynamic removes additional supply from the market, accelerating the scarcity cycle. What begins as an industrial constraint evolves into a strategic competition for a resource that underpins both economic output and monetary stability. Financial markets provide the final reaction, where scarcity meets leverage. Silver has long operated under a structure in which paper claims vastly exceed physical availability. When inventories fall toward zero, that leverage transforms from a source of liquidity into a point of fragility. The system remains functional only as long as most participants roll contracts rather than demand metal. If even a small percentage shift toward physical settlement, exchanges face difficult choices: raise margins, restrict delivery, or settle in cash. Any of these measures changes market psychology overnight. These reactions share a single theme. Scarcity does not remain contained. It spreads. It alters incentives, pricing, and risk tolerance across every segment of the system that depends on the metal. And once these adjustments begin, the market transitions from debating supply deficits to operating within them. That shift sets the stage for a more consequential question: how the world recalibrates when silver becomes a persistent bottleneck rather than a dependable input. The shift toward a zero inventory environment marks more than a tight commodity cycle. It signals a transition to a market structure governed by scarcity rather than abundance. The silver sector is already moving in that direction. The question now is not whether the market adjusts, but how quickly and through which channels the adjustment unfolds. In the near term, price discovery will increasingly reflect the physical market rather than the derivatives market. Premiums are likely to widen as fabricators and industrial buyers attempt to secure allocations before downstream bottlenecks emerge. That behavior creates a feedback loop. Higher premiums draw more investment demand, and investment demand accelerates the physical drawdowns that prompted the premiums in the first place. Price becomes both signal and stabilizer, rationing limited supply as the system searches for equilibrium. The medium-term outlook depends on the market's ability to expand supply, yet the constraints are significant. New mines require capital, permitting, and supportive commodity prices sustained over multiple years. Byproduct output depends on base metal cycles that rarely align with silver's needs. Recycling remains limited by technology and by the long lifespan of the products that embed silver into non-recoverable applications. These factors indicate that any supply response will lag demand growth, reinforcing the structural deficit already visible in exchange inventories. Industrial users face a strategic choice as a result. Some will redesign components to reduce silver loadings. Others will diversify suppliers or negotiate long-term contracts at higher cost. A few will absorb scarcity premiums because substitution would compromise performance. Energy and technology sectors, where reliability is non-negotiable, have limited flexibility. Their demand persists even as costs climb, positioning silver as both a strategic input and a potential vulnerability in future investment planning. Sovereigns will interpret the environment through a different lens. Nations with large manufacturing bases or exposure to geopolitical risk are already shifting towards strategic accumulation. If visible stockpiles remain near zero, that trend strengthens. Physical silver becomes not only a hedge against currency volatility, but a safeguard for industrial continuity. What begins as precaution can evolve into policy, removing additional supply from the open market and tightening conditions further. Financial markets will adjust last, but their adjustment will be the most visible. As inventories thin and delivery optionality narrows, the gap between paper liquidity and physical availability will define market psychology. If confidence weakens, the system may migrate toward higher collateral requirements, reduced leverage, and greater emphasis on allocated holdings. These changes do not dismantle the paper market, but they alter its role, shifting influence toward physical fundamentals that have been muted for decades. The long-term outcome is a repricing of silver's economic role. A metal once treated as abundant becomes recognized as strategically scarce. A commodity long viewed as inexpensive becomes valued for its irreplaceability in both energy transition and digital infrastructure. And a market historically dominated by financial positioning becomes anchored to physical flows that no longer tolerate disruption. The implications extend beyond price targets. They reshape how industries plan, how governments hedge, and how financial markets manage risk. In a zero inventory world, silver becomes a barometer of systemic pressure, revealing not just the state of one commodity, but the balance between technological ambition and the material resources required to support it. The collapse of visible silver stockpiles does not mark the end of a cycle. It marks the beginning of a new market regime. A commodity once buffered by ample inventories now operates without the surplus that kept prices steady and supply chains predictable. The shift is structural, not temporary. Demand continues rising from technologies that define modern growth. Supply remains constrained by geology, capital discipline, and policy friction. And the financial system that once masked tightness with paper liquidity is being pulled toward the physical limits of the metal itself. This convergence changes how the world values silver. It is no longer treated as an overlooked industrial input or a secondary precious metal. It is moving into the center of energy policy, manufacturing strategy, and monetary risk management. The market is adjusting accordingly, through higher premiums, more volatile prices, and a growing emphasis on physical possession over contractual claims. In the end, the numbers are telling a straightforward story. When inventories fall to zero, everything else must adapt. Prices, procurement strategies, investment flows, national policy, all recalibrate to a world where silver can no longer be assumed abundant. That recalibration has already begun, and its trajectory suggests that scarcity, not stability, will define the metal's next chapter.